Warning. This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and this is the weekend's deep dive. On the weekend, we like to run through the base case hypothesis on the channel and check to see if, largely speaking, things are still going according to plan. So, as ever, we're going to do the same thing as we always do, run through this thing from the top down, check to see how the progress is going. For stocks, the idea was we were going to be having this blow off top, run to new all-time highs, come tumbling down in a global bear market and recession, and in this recession we would have a deflationary component for a couple of months. We have also been speculating that once the highs are in, it will likely remain the highs for some time as we experience a lost decade in the stock market, and the focus on this channel will likely pivot to a more commodities-based trading channel. Fast forward to today, and it looks like we are well and truly in that final blow-off top moment now. If you ask me, it looks eerily similar to this, right? The first sell off the bear trap and then the push into the euphoric blow-off top. If we're going to draw a line across the prior or high before the tariff tantrum spill, okay, I make the case we've got to be right around here by now. Okay, and if I hop back to this chart, of course, there's the prior high. If we draw a line, you know, we're considerably above that, aren't we? So it doesn't mean we can't continue to trend up for longer, but it does mean that this cycle is concluding with a parabolic blow off top that is likely to come tumbling down in spectacular fashion. For Bitcoin, the idea is that we've been having these weekly cycle lows, which of course we chain together to give 4-year cycle lows. Out of each prior weekly cycle, we did get, approximately speaking, a double from the weekly cycle low to the weekly cycle high, and we would speculate, and that's what we'd get again. From a timing perspective, everything played out according to plan so far. But it is important to note, while we were calling for a double, we actually needed to squash the right-hand side of this chart down. So from my cursor, everything to the left will stay the same, and everything to the right will get squashed down as I make this adjustment here. And this is what we ended up with. So about a 70% move from the low to the high instead of 100 like we were looking for. So it's kind of like waning momentum. That's my interpretation here. But from a timing perspective, we have still landed in the weekly cycle low window in line with the timing arc, and we are getting ready, in my opinion, here to get that final push. Now, the real question for me is this final push going to be in line with my yellow squiggle? Are we going to get a nice 100% plus rally from this weekly cycle? And are we going to get that done in very short order? I'm looking for somewhere between 4 to 12 weeks once this low is confirmed. Or is this waning momentum, this lack of a double here, going to be indicative of a more distributive type top? Are we going to get something more lackluster and then start to head down for that 4-year cycle low? Ignore the numbers, of course, it's just a squiggle. But one thing I do know to be true is there is only 2 more weekly cycle lows before the 4-year cycle low is due. Okay, so regardless of the path we take in the meantime, if we're just looking at the weekly cycle lows, the arcs down the bottom, okay, we're in the process of carving out a weekly cycle low here. There'll be another one kind of middle of 2026, about May, and there'll be another one sometime around December or November, and that one around December or November will also be marked and counted as the major 4-year cycle low. So we have used up the bull phase of the 4-year cycle, just like how we've used up the bull phase of the 4-year cycle for the S&P. This here was a 4-year cycle low, and we have one due, like I said earlier, right around the same time, and the same is true of gold. Gold is due a half cycle low right around the same time in its 8-year cycle, aka its 4-year cycle low. So as far as I'm concerned, if I can just do my job here, which is get out near enough the top to call it the top, and then watch this market change trend for 2 weekly cycles to carve out a 4-year cycle low, then all will be right with the world. And I know there'll be a million reasons why ISM's going up and it's a 5-year cycle now and whatever, but frankly, as a cycle trader, I don't care. I stick to my edge, okay, and I don't have to even start to entertain Q1 on Q2 tops until this current weekly cycle right translates. Okay, which simply means we draw a line through the halfway point of this weekly cycle. Okay, any top that forms to the left-hand side of this weekly cycle here, measured low to low, will qualify as left translated, and any peak that happens after that, okay, will qualify as right translated. Until such time as this market proves to us by putting in a new all-time high to the right-hand side of that midpoint that it wants to do a right translated cycle, okay, I don't think we have any business entertaining that this cycle is going to be radically different from the others. And if what happens here is, regardless of a new all-time high or a more lackluster rollover, okay, if the peak for this weekly cycle here forms to the left-hand side of the midpoint and we can mark it and observe it as left translated, then all that will do is signal that the impending coming low is going to be below this low, okay, below the prior weekly cycle low. and thus we would label this a failed cycle because it traded through the prior weekly cycle low level. Then from there, we would again expect bearish price action, which would be a left translated cycle peak, followed by a rollover, a decline, and a cycle failure, meaning we trade below the prior weekly cycle low. And this is how we get our downtrend, and this is how we label our 4-year cycle low as well as our weekly cycle. So for me, the read is very simple, okay? It is either we are about to melt faces here, have a double, and everything will be right with the world, everyone will be happy, and we can sell hopefully a big final trend line breakdown higher up. The other option is that we're not going to get that and we're just going to kind of range here, left translate and roll over, in which case then we've already seen the high. And to be fair, the absolute irony here is whilst everyone was originally earlier on in the cycle cheering on this cycle not being any different and topping around the middle to late October of this year, they would have gotten all the way there, observed that to be the top, and then moved the goalpost right at the last minute, right? So if something like this happens, it would just be cycles doing cycle things. If something like this yellow squiggle here happens, and then it does this, okay, that would also just be cycles doing cycle things, nothing out of the ordinary. For me to even start to entertain that this time is different and something is vastly different to the cycle structure, we're going to overrun in a manner that we have never seen Bitcoin overrun before. For that to occur, I need to at least see this current cycle right translate, which simply means we're going to put in a new all-time high to the right-hand side of the halfway point of this weekly cycle. So it really is that kind of do or die moment here. I can see the frustration, I can see the rage quitting out there, I can see people coming up with all kinds of narratives, but frankly, I think it's just them flying flags to show that they do not have a system with parameters that instructs them how to act, right? For somebody that has a system and can operate inside of that system with very clear rules for when to act and when not to act, this is really just another day in the office, right? There's actually not that much craziness going on here. It's just a little bit disappointing for me personally, because I was really hoping to see 150 to 200k this cycle. And if what happens here is this, okay, then we're obviously not going to get that. And that just means I'll end up locking down less profit than I'd originally hoped for. But it's not the end of the world, right? At the end of the day, the market owes us nothing. Our job is to get in low and get out high. Okay, that's our job. And if that high is here as opposed to up here, then so be it. There's nothing we can do about that. We can't control where the market is going to top. So when I say do or die, it really is do or die. Okay, we really need to see this weekly cycle hold. We need to see this weekly cycle push up and strongly. Otherwise, we're just going to have used up too much time. I will also say this, regardless of whether we get the rollover or the yellow squiggle to new highs first and then the rollover, I expect when I come to sell, assuming it is left translated and I don't have to entertain more drawn out lengthened cycle ideas, I expect this to be incredibly contrarian. At the time, I expect most people not to agree with me. I expect most people to mock and jeer at the idea. And if for some reason they're not and everyone's on my side and trying to 100x short this thing and jumping up and down and screaming, that was it, the top's in, blah, 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 then I might actually be concerned and start thinking instead what we want to do is perhaps entertain getting back long out of a next weekly cycle low or something like that. But there's a million possibilities, and I really don't want to entertain more than just those two I've spoken about until such time as we get a right translation. That would be the cutoff for me to say, okay, something else is going on. But if this cycle left translates, whether it's to a new high or a lower high, all that really does to me is cement that the cycles are doing exactly what they're expected to do. And that's why we use them. So we've definitely still got a chance, but those chances are waning, okay? We have to acknowledge the waning momentum here in the fact we got 70% instead of 100 plus. If this thing was steepening into a parabola, then these actually should have increased. This should have been more than 100 and then more than whatever this one was, right? It should have got steeper and steeper, and it hasn't done that. So we just have to acknowledge that. And it's exactly the same as what we saw back in 2022. Okay, we just got this orderly walk up, a sneaky rollover. Nobody even believed it was over until we were at the lows. Then we ripped their faces off with a 20% counter trend rally, and then we rolled over again. Everyone's screaming doom fractals, right? 2008, we're only halfway down, and that of course was the bottom. And we knew it was the bottom for two simple reasons. Number one, this was a 4-year cycle low that inverted year two. Okay, again, cycle system telling us what's up. And number two, the sentiment was so extreme there that it was making my blood boil as a contrarian, right? It was just a very obvious trade. There's no way that we were going to keep going lower with everyone screaming we're only halfway down. Everyone was cheering on recessions and crises, and we just didn't have that as the backdrop. It was just silly to say things like that back then. And by the way, if you're new to cycles and you want to learn how to do this stuff, I have made it my mission to bring cycle trading to everyone. If you are lacking a system and a framework that tells you when to act and when not to act, and you want to get hold of one, then there's a tutorial playlist in the playlist of this channel, which is totally free. You can go and watch that and learn how cycle theory works. If you want a slightly deeper dive, there is a PDF
PDF you can get hold of in the pinned comment and description to all videos. And for the next 6 days, we are offering a $130 saving off of the camelfinance.co.uk website, which contains absolutely everything you need to know about cycles, including a cycle trading indicator that will pick all of the lows for you. So in summary, right, for the stocks and Bitcoin, so far so good. We apparently are in this blow off top for the stock market, and we don't really have to worry about breakdowns just yet. I think we've got a couple more weeks to months perhaps of climbing before then we're going to get a spectacular breakdown. For Bitcoin, I suggest we do have a little bit more risk here, okay? The only way I can kind of de-risk the idea that Bitcoin is close to a top or is already topped is if in the next few sessions we just come screaming out of here in a near vertical manner, okay? We're going to have to get the double off the lows here, or let's say at least 70% like the prior weekly cycle. We're going to have to get that done in under 3 months to be able to qualify for left translation. Okay, so it really is like a now or never moment, and the longer we trade sideways and range, then the more likely it is there is no blow off top here. Okay, so I still think we can cheer it on, and Bitcoin does like to do these really face melting rallies. It likes to get most of its move done in just a few weekly candles. I mean, this one here was 90% in just 7 weeks. So, you know, something like that to repeat here would be absolutely fine. We're definitely not out yet, but again, remember, with every week that goes past, particularly if we can confirm a trend change here with left translated weekly cycles and cycle failure, meaning we trade below the prior weekly low, then that is the confirmation that the trend has changed. The market has rolled over and we are heading for a 4-year cycle low. And there'll be lots of people that want to say, no, that's not how it works, or no, ISM's up, or 5-year cycle. But frankly, they're wrong. Okay, it's just simply they are wrong. Once we start to fail weekly cycles, we absolutely have a confirmed trend change in place. And that's why we use cycles to guide us. Okay, as I said right at the start, I expect there to be a global recession, not just a bear market here. I expect during that recession for us to slip into a short period of asset price deflation, which brings me on to the next component, right, which is anything you do to the M2 rate of change shows up in the CPI with a lag. I keep calling for continuation of disinflation before ultimately reaching a short period of asset price deflation. Shout out E here, who has very kindly been updating these charts for us, and most recently has created a version of this on TradingView. A lot of people at the moment are pushing back on this and saying, look, this shape here looks nothing like this, okay? And yeah, you are kind of right, but it doesn't have to look like that one-to-one. It just means anything you do here tends to show up here with a lag, okay? And if you look at 2008, there's nothing like a good old financial crisis and a big rally in the stock market getting blown out and crashing to the downside to cause inflation to completely crater. And since we are in a very unusual structure for the S&P 500, since we're extraordinarily bullish here and extraordinarily vertical, it seems only reasonable that when this thing breaks down, it's going to do so spectacularly. And when it does, there's no quicker way to usher in deflation, okay? So I still maintain that this thing is going to continue to move down. I also wanted to point at trueflation here because, again, I'm getting lots and lots of pushback. And it's funny, what happens is the overall trend is down, okay? And then there are some counter trend wobbles because nothing moves in straight lines, okay? And in each one of these counter trend wobbles, people come out and start being incredibly toxic. They start calling this idea dumb. They start saying things like, well, the bread in the supermarket's not going down, so you're obviously an idiot, you don't know what you're talking about. When in fact, we are measuring rate of change here with the CPI. We are not measuring absolute inflation, which means the rate of change, CPI, can continue to move down to new lows, whilst the bread in your supermarket continues to get more expensive, okay? So people are very quick to come out and be a pain, frankly, when we get a counter trend wobble, like in here, okay? People were incredibly toxic and loud. And then in just a few months, right, probably the drop from here to here was 6 weeks. We went from over 3% to under 1.4% CPI, okay? And then all of a sudden, everyone that was very loud and jumping up and down and screaming, I'm a fool back here, just disappeared and went back to hide underneath their bridges, okay? And I'm seeing the same pattern now. People are looking at this and calling me a buffoon because they think somehow this is going to manifest as 20% inflation again, like we saw off the back of the C19 era. But I am here to tell you this is nothing more than, again, a counter trend wobble and will soon be about to roll over to the downside to new lows. And all of those people that cannot tell the difference between rate of change, which we are measuring with CPI, and absolute inflation, I submit to you, are going to go silent again and crawl back under their little bridges. Now, I understand that when we're zoomed in like this, being tape slaves, this absolutely is and looks like an uptrend. I'm not trying to say that that's not what this looks like, okay? And short term, yes, since about April, it is indeed an uptrend of higher highs and higher lows. But the bottom in green is the rate of change of CPI down the bottom, okay? Your uptrend since April looks like this, okay? This is what you are harping on about here, talking about resumption of inflation, sticky inflation, inflation's out of control, the Fed needs to hike rates. Okay, this is what you are basing those types of claims on. So this call is still very much intact. Deflation is still the risk here, as is continuation of disinflation in the short term, and this too shall soon roll over and do so violently, just like we saw back here. Also, it seems pretty sus to me that the White House does not want to be releasing any inflation data next month. I wonder why. Is it because finally the shelter component is going to reveal the truth behind the CPI metric? In blue is the CPI shelter component, okay? You can see here it's remained elevated for a long time. It's a big laggard in the basket, and it is responsible for the elevated and seemingly sticky CPI print. In red is a real-time metric, ALNRI, okay, and it has been deflationary for well over 18 months now. So is it now finally time for this shelter component to start to roll over and catch up with reality? Okay, is it now time for the lagging metric that is shelter to actually start to decrease, and thus we are finally going to see CPI dropping like a stone, in line with the base case hypothesis on this channel since the top call in inflation back in 2022? I think so. And the reason I'm so confident in that is because when we swap CPI, rate of change, year over year, with this real-time metric instead of shelter, what you'll notice is for both headline and core, we have been well below the 2% inflation band since the middle of 2023, okay? It is a complete psyop that inflation is sticky. So that call is absolutely still intact, make no mistake about it, which brings me on to the next component of this. If we're going to have that deflationary bear market and recession, we will need to see labour market deterioration. It's been a long time call that the labour market will continue to soften. We'll continue to see weaker and weaker jobs reports until eventually we reach recessionary levels for the labour market. And that's exactly what we've got at the moment, okay? We've got massive misses in practically every metric for employment. On top of this, more recently, we've got the Fed losing 20% of the data that it's supposed to be making the rate decisions on, okay? Again, just like the CPI data that's not going to be released next month, I also suggest to you there is some chicanery afoot here pertaining to not only the inflation data, but also to the jobs data. And at the same time, we may already have slipped into recession in the past month or two because they just revised down the jobs by almost 1 million. It's the largest cut in history. Meanwhile, the government remains shut, so we haven't got any updates on this labour market data, at least not for now. Even if they updated it, let's be honest, can we trust it? Not really. Are they going to revise it quietly down later in life? Yeah, most probably. And are we going to continue to maintain this current trend, which is towards continued labour market deterioration? Yes, I think we are. Okay, this is certainly curling up, looking for a big pop, just like we saw in all prior instances of recession. You can see this exact same thing with the unemployment rate for 16 to 24-year-olds. It's looking even worse at the hard right edge. And you can see this exact same thing with a U6, okay, which is the 6-month moving average for the labour force participation rate. Again, starting to curl up, okay? This is not improving by any stretch of the imagination. And so that brings us on to the rate cuts, right? Apparently, if you ask your average market participant, rate cuts are bullish, liquidity is coming, easing is coming, the end of QT is perhaps coming, the cessation of balance sheet runoff is also coming around the 1st of December, and so we must be early days in this bull market. But again, I suggest to you the majority of the market has got this wrong. The market doesn't know whether we should be remaining paused, okay, or whether we should be cutting again into December's meeting. And they are basing this, remember, on 2 pieces of manipulated data, the CPI, which is clearly a psyop, as I've shown you already, and the labour market, which again, there seems to be some chicanery afoot there, despite the persistent overall trend of labour market deterioration. So the bond market, in aggregate, which is who sets rates, is unsure of itself at the moment. It's not really sure which to price in. Do we remain paused at the upcoming FOMC, or do we see another cut? If you ask me, this is going to continue to reprice in favour of putting more cuts on the table, because the bond market is going to figure out what I figured out, and that is that the Fed is indeed behind the curve, inflation is indeed well under control despite this counter-trend rally, and the labour market is significantly worse than they have been letting on for a long time. So thus we really do need to react to this lagging data and do so quickly, and thus I do believe the bond market is going to determine that rates need to be lower despite them currently putting in a counter-trend bounce. And again, the reason I'm so confident about this is because context is key. Whilst everyone is jumping up and down and saying rate cuts are bullish, liquidity's coming, easing's coming, it's early in the cycle, the reality is we are actually cutting into a recession, which is bearish historically, okay? Now, we've already seen a couple of cuts since the Fed resumed its cut-in cycle after the cut from back in September of last year, which means we are rapidly approaching that 3-month mark where, historically speaking, the stock market starts to become stressed, okay? We start to see financially stressed conditions. Can it roll past the 3-month mark by a month or two? Of course, okay? But could it happen immediately as well? Yes, anything and everything is on the table. I'm not in the business of trying to tell you exactly what day the market will top. Instead, what I am here to tell you is, whilst the rest of the market is looking for rate cuts into a soft landing, I am here to tell you these are much more likely rate cuts into a slowdown, and thus will actually be bearish despite the majority of market participants looking for these cuts to be bullish. And again, I make the case that these market participants are going to continue to cheer on a soft landing because they're looking at things like the face value for the GDP data, which grew 3% in Q2. Mind you, though, if we take out net exports, it was negative 2%. So again, more chicanery afoot with the data. We also know that market participants continue to combine their ideas of bullish rate cuts easing coming and growth for the GDP with earnings beats coming out, okay? But we are consistently continuing to preach that we are working towards building up of impossible expectations, and that very soon we are going to start to see the market realize it has been overzealous with its expectations for these companies, and thus we are going to get a whopping great mean reversion. So it seems to me the market is largely speaking offside here. It doesn't mean we can't trend higher for a little while longer, okay? I think we can for up to about 3 months here, but then eventually we are going to have at least a significant correction, if not a lot more. And because of where the 4-year cycle lows are, I suggest to you it's going to be a lot more. At the hard right edge, we have no real push here from the high yield credit spreads, so we don't have to worry too much about this. I've been saying for a long time, all the while it kind of chops around in here. No alarm signals are fired, but once we get some true breakdowns from this blow off top angle in the stock market, we should expect this thing to spike and spike rapidly, and we will use that as a confirmation tool to say, yes, the top is really in for the stock market. And a similar concept applies with the yield spreads, okay? When the yield curve inverts, everyone screams recession, they're wrong, and they do the same thing when it reverts back above zero, but it is actually the acceleration to the upside that is synonymous with the tops coming in for the stock market. And similarly to the high yield credit spreads, we also use this as alarm signals. So we're still trading in a range from all the way back in April, still sideways, which means there is no alarm signal here. Looks nothing like the accelerative sweep we saw in the C19 era or the GFC or the dot-com bubble burst. And so we continue to expect this to trade sideways in a range until such time as that blow off top angle in the stock market breaks to the downside. But when it does, just like the high yield credit spread breakout here, synonymous with financially stressed conditions, will confirm that breakout is for real, so will the accelerative sweep to the upside in the yield curves. And so all the while this keeps trading sideways, we can continue to stay long and strong. But as soon as we start to get breakdowns and this thing pop to the upside, it will confirm that the top is absolutely in. We can sharpen this yield curve, by the way, from the 10-2 to the 10-year 3-month, and we get an even sharper signal, which gives you even less time to react, okay? And looky what we have here. As of this week's close, we have a breakout of this squeezing structure. This can really go either way, okay? If it continues to just kind of chop around in a range and move sideways, then fine, we can continue to stay long and strong for a while longer. But historically, when this thing pops, you have almost no time to react, and the top is usually already in, okay? So we have to watch for a big accelerative push here. It would be important to check for that. Really, we're going to need a higher high. If the stock market breaks down from that blow off top angle, I would think this punches through that prior high level in a single weekly candle, and that will probably be enough for me to confirm that the top is in for the market. So again, we need to keep an eye on this alarm signal here and make sure this thing continues to trade in a range a little while longer if we're going to continue to have confidence in our long bias and long positioning. You can see just how far away we are. This is a weekly time frame for the S&P from that 4-year cycle low. We already know how close we are to the 4-year cycle low for Bitcoin, and gold is a very similar deal, just with its half cycle low and its 8-year cycle. So I continue to make the case we are indeed on borrowed time here, but we're still long and strong. We're still pushing these trades, right? We're still riding these blow off top angles, and we're going to continue to do that until we have reason not to. For gold, this could really go either way. I'm looking for this to continue to push here. I'm kind of operating with a zero tolerance policy. Otherwise, if this thing is going to roll over from here, then we are going to cut these positions, including all the minor positions, and get out. I added a silver position, which didn't feel good, but that's mainly the reason I added that, and the fact the technical setup is really clean. So we'll see what happens from here. But I think the days are numbered for the precious metal markets. Again, if I pull up this gold chart and zoom out a bit, this is what I mean by the 8-year cycle lows back here, and our half cycle low in the 8-year cycle is also synced up around that same time. Okay, so if everything tops between now and the next few months, okay, no one is going to be able to say we couldn't have seen this coming. It's going to be extremely obvious in hindsight. And the same is true of Bitcoin, right? We already kind of covered this extensively, but I keep drawing these same two squiggles. One is the yellow squiggle. This would be the left translated weekly cycle to all-time highs. Happy days. Down we go to the 4-year cycle. The other idea is that we left translate with a more rounded top to a lower high, and same deal, right? We're going to have to sell the left translation and start to target the 4-year cycle low. Again, I want that to be as contrarian as it was to buy the lows back in the 2022 bear market lows in the last 4-year cycle. So we'll be keeping an eye on sentiment there. I'm liking this counter trend bounce we're getting from the yields at the moment. Okay, I expect this to push up just a little bit higher and probably set us up for our entry in TLT. For those of you that know, you know, before then ultimately rolling over into the end of the month and putting those rate cuts back on the table for this Fed Watch tool right here, because of course it's the bond market futures that control this. If you enjoyed what you've seen today and you made it this far, then consider hitting that subscribe button and following along. If you're a level 3 member, look out for the members only video I'm going to post for you guys. And until next week, have a fantastic weekend. All the best from me. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a badass, oh yes indeed. Camel